Okay, so on to our very last screencast of the unit, monetary policy, strengths and weaknesses. First, let's deal with the strengths, some of the reasons that we have monetary policy and don't just leave it up to fiscal policy. The first strength is speed and flexibility. Fiscal policy takes a really long time. You'll remember those time lags involved. With monetary policy, it doesn't take quite as much time. The Federal Reserve can buy or sell government bonds, for example, tomorrow and in any amount. So it's faster than fiscal policy is, and it's also more flexible. It takes a long time to change taxes or to pass a law in Congress. The Federal Reserve can act really quickly. Maybe more importantly than that, the Federal Reserve is isolated from political pressure. Remember, they're appointed and they have relatively long terms. So they don't have to worry about getting elected or pleasing voters. They're kind of like the responsible adult. When the federal government's off spending money it shouldn't be spending or what have you, the Federal Reserve doing monetary policy can actually do the right things without worrying about the political backlash of doing those things. Another strength of monetary policy over fiscal policy is that you don't have to worry about those crowding out or net export effects like you did with fiscal policy. And in fact, monetary policy actually helps with the crowding out and net export effects. Let me show you why. To do that, I'm going to use the money market graph that we've seen. I could just as easily do this in the loanable funds graph, but just to keep with the money market graph, let me show you why monetary policy might be a little bit better. You'll remember that with fiscal policy, when they wanted to increase government spending or cut taxes, they had to borrow money. And what that did was increase the demand for money in these markets. When the government wanted to borrow money, big increase in the demand for the use of money. And that had the unfortunate effect of making interest rates go up. Those rising interest rates had a kind of a countervailing effect to what we wanted to happen. Higher interest rates make investment go down, and that's the opposite of what you're trying to do if you're trying to run an expansionary policy. So we called that the crowding out effect, and it also turned into the net export effect, and it was kind of this bad thing that happened with fiscal policy. Monetary policy doesn't move the demand for money in this market. Monetary policy actually moves the supply of money. So when we're dealing with monetary policy, if it's expansionary, instead of increasing the demand for money, what they would be doing is increasing the supply of money, shifting the supply of money over to the right. You'll notice that that has the exact opposite effect on interest rates that expansionary fiscal policy did. With expansionary monetary policy, they can actually make interest rates go down, which is what we want to happen: more investment spending, more consumption spending. So it's one of the nice little things about monetary policy that it has this effect. And in fact, monetary policy can be used to cancel out the crowding out effect that fiscal policy causes. So for example, let's say that expansionary fiscal policy happens. The demand curve shifts to the right and interest rates will rise. Well, if the Federal Reserve wants to kind of cancel that out, one of the things they might do is simply increase the supply of money at the same time. While the Federal Reserve is doing their expansionary fiscal policy thing, when the government's doing its expansionary fiscal policy thing, the Federal Reserve could increase the money supply at the same time and cancel out that effect of higher interest rates. In fact, if it overcompensates, it could actually make interest rates go down. All right, so we've dealt with the strengths of monetary policy. Let's deal with some of the weaknesses. First weakness is that the Federal Reserve over time is losing control over the money supply. A couple reasons for that. First off, different things are being used as money: PayPal, electronic payments, those kind of things. And the Federal Reserve doesn't really have control over those things. Secondly, as the world becomes more global and as foreigners hold on to more of our money, what we do in the United States has less effect on the money supply than what would happen if all of the money was here. Another weakness of monetary policy is changes in velocity. Remember, velocity is how many times a dollar is spent over the course of a year. And that changes over time, as we're going to see in a later unit. As velocity changes, it has an effect on the effective money supply out there in the economy, and that complicates things for the Federal Reserve. Finally, there's something called cyclical asymmetry, which essentially means that tight money policy, trying to move AD to the left, is more dependable than easy money policy, trying to move AD to the right. The reason for that is that the Fed can stop banks from making loans by simply raising the reserve requirement, for example, to 100%. But the Fed can't force banks to make loans. Even if they reduce the reserve requirement to 0%, it still relies on banks to finally make those loans. And banks tend to work in a kind of pro-cyclical way, meaning that in good times they make lots of loans, and in bad times they tend not to make loans. So when times are too good, when aggregate demand is too far to the right, the Fed can shut that down by reducing the money supply, cutting off loans, and pushing AD back to the left. But when times are bad, when aggregate demand is too low, the Fed can incentivize banks to make loans by lowering the reserve requirement or lowering the discount rate or what have you, but it can't, in the end, force the banks to make those loans. And that might have a dampening effect on the intended monetary policy. All right, so that pretty much wraps up the unit on monetary policy. Hopefully it wasn't too terrible for you, and I will see you next time.
Damn it, this is too hard! Here's what I think of your test, Mr. Teacher!